Well, hello guys, glad to have you on board again today. We're Wednesday, which means we are looking at H1, H4 timeframes. I need anything below daily on a regular basis, once a week, and we're pretty much halfway through this week. So let's do kind of a review of where we are so far, what's been happening so far, what's next to come, all of these things. So first and foremost, we're going to mention these. Everyone's been seeing the latest drop in Bitcoin, whatever the information that triggered it was, I don't give a fuck. All I could tell is that the liquidation amounts are significantly low. They're still piling up at lower levels than the previous ones, still leading me to believe that the same old story. Just look at yesterday's video as well. These devaluation patterns on extreme deviation to mean value to the downside due to feedback loops. Specifically, we've mentioned two of them, the depressive environments and the cascading liquidation. Definitely we are into this for cryptos, so we are in a favorable environment for these patterns to play out, which will shift momentum and psychology to dangerous distortions that will make lots of traders make trading mistakes in those environments. So if you have it in your mind, you would efficiently navigate those things without falling for the cracks. So have a look at yesterday's video if not already, but this is the sign that just once again confirms the availability of that pattern. As the time passes, people tend to forecast that liquidation will be bigger and bigger and bigger and bigger and bigger, but turns out the reality is that it is not the case. So we might have found a rock solid bottom in which, despite tremendous amount of energy spent trying to liquidate people, we no longer do this. So we'll see all about that. Of course, I don't know anything about the future. Maybe the big crash, big reset. I've seen some of those videos actually being pulled out yesterday. Someone actually saying that the massive $1.5 trillion debt crash is around us. It's going to come, whatever. I mean, let's make it plain simple. You have just as many chances to succeed on kind of forecasting such very rare events and just winning at the lottery. So let's just make it plain simple. Math has been debunking that lottery stuff for years. This is not a winning strategy. You just can't make money out of lottery. It's just a negative reward expectation. It's just as simple as it is. Just a very few chances to get a lot of money, but the reality is that the more you play, the more you lose. That's the fucking math, and no one can compete with that. So it's exactly the same for me into forecasting endlessly cascading events. The further down the rabbit hole you go, the less likelier the next step is to actually occur. And we're now at a stage in which, in order to go further down this rabbit hole, we need to trigger some of those $1.5 trillion debt crisis, whatever. But the reality is that this one has significantly less chances to occur than the previous one. The previous ones had to line up almost perfectly, and it was already kind of significantly lower probabilities. We had to trigger Luna, and then we had to trigger a Celsius and 3 arrows capital, or 3 arrows and then Celsius. These things had to line up perfectly. Well, the probability of these snowball effects to keep on playing gets narrow and narrow as we move ahead. And the numbers keeps on confirming that we hardly get liquidation now. So, do you really want to bet on the fact that the next big crash is around us? Don't be dumb, okay? So really that's what this is all about. Just wanted to quick intro on this. Okay, despite that, if we have a look at our usual dashboard, we'll see that the sentiment in Wall Street is still pretty neutral. The retails have been washed entirely, meaning that they were short selling in here, they got wrecked, and now we go back to the moving average of some kind, and of course we're back to neutral areas. So that means this is favorable for technical structures to play out. We can definitely trust our technicals because there is no clearly defined retail positioning in the market, and therefore the market maker doesn't have a counterparty to just wash around. So I think now it's a matter of technicals, and of course we would understand that tomorrow is the big day. I mean, this is where we're going to get the rate decisions in Europe, and from what I can see, Powell is just going to squeeze in. So I don't know what the fuck he's going to talk about, but tomorrow is the big central bank day. What are we going to get, and so on. So same old stupid narrative about that. I sincerely invite you to have a look at the video about forex markets, because all the stupid narratives that I see recently are all around around the same topics, that the Fed is very aggressive, they're going to tighten so violently that they're going to crush the economy, that the ECB is very late in their tightening cycle, so this can only but deteriorate the euro. There is too much difference between the euro and dollar yields, so it can only deteriorate your dollar. Okay, bullshit all along. The thing is that, of course, different economies might have different monetary policies. Of course, 2% yield in the US doesn't necessarily create as much credit demand than 2% in the euro area, so stop that bullshit. Don't try to compare on a raw value the yields. That makes no sense. Different economies have different way of behaving against credit. So just don't be dumb enough to say they have to be equal. They certainly don't have to be equal. It's a matter of how much credit is demanded and how much money is created. We've made an entire video about that. And this is the relative shift toward momentum of monetary creation that creates the big flows, inflows and outflows from one currency to another. These are the big forex trends. And from what we've seen, there is a likely probability that now Europe will catch up on US tremendous money inflation, a tremendous money creation process that has been the post-COVID era. So now they're tightening and the Europe is probably going to take over. And what we've seen is that it will likely create the opposite effect. It will push the euro's prices up instead of the opposite. So it is totally contrarian type of indicator, but that's the thing we've studied. This is how big money supply tend to move around in our complex world. So this is not the only factor, but this is the predominant factor. Anyway, look at the video if you haven't. This will be very informative. Okay, in terms of charts now, because that's what we do more than anything else, okay? We have to have a look at shorter time frames because that's what we do here. So Ethereum, what we could say is that in the 4-hour reference charts, the context hasn't changed at all. We're still trading the pattern that I have highlighted in yesterday's video, meaning that we had all the preceding cycle in which the volatility has narrowed. Everyone was targeting a bearish break out of it. We got a bullish one. So this is phase 2, phase 3. We break out of the range. No one triggered their stop losses. They kind of figured out this is a retracement bullshit. Okay, go look at the video if you didn't really understand that. We're in phase 4 currently as we're building range by oscillating across the trend channel. Okay, we reject trend channels boundaries and we're oscillating near the moving average. The oscillation can be all across the moving average, above or below, just like we do. Of course, latest movement in the Bitcoin has been pushing Ethereum down to reject that moving average one more time. But look at the thing, we're still really trading in the resistant context, inside the trend channel. So as long as we don't reach out to the context, it's still the clear evidence to me that we're accumulating everyone until we succeed breaking out of that range and breaking out of the moving average. The bigger problem in here is that people try to give it a form. They try to understand and predict what structure this range will take, though it was supposed to be a triangle first or whatever, and this is the big mistake people do now. Ranges are unpredictable structures. They can take many forms. Yes, they do tend to resonate to some recurring forms like the symmetric triangle or flags or whatever. But the thing is that they can do whatever the fuck they want. It's just they're building boundaries by rejecting technical areas. So in that perspective, we are rejecting the moving average, but I tend to focus that we're going to break it at some points because, of course, the area in between will get narrower and narrower. So either we're going to get to invalidation or we're going to just succeed. And until then, that's the Schrodinger's cat box. Don't try to be among the ones who just comment on random price movements. As long as we don't make new lows, there's nothing to worry about. But as long as we don't break the moving average, there's nothing to brag about. So it's just really waiting until then. Remember that those who make money in the market are not those who seek the truth. It's only those who risk manage correctly. And of course, sometimes you're going to be right, wrong, whatever. When you're wrong, you lose less than what you're right, than what you make when you're right. And that's just as simple as it is. Don't seek to be true or fear of being wrong. That's not what makes money in the market. Okay, Atom is pretty much in a similar situation to me. The single difference being that Atom is flat ranging across the moving average. Bitcoin is on the verge to do the same to me, meaning that I don't think Bitcoin is any such a thing as being bearish. We've gone from context to context. I think we're building a higher low point or eventually double bottom. Who cares? Next technical area is to go for this moving average, and I personally think that we're going to liquidate everyone in the meantime and go straight up to 29K, which will literally cause us to oscillate across, but probably above this moving average, in my personal opinion. Of course, this is far more speculative and dangerous to do in terms of Bitcoin, because normally we're not supposed to retrace the previous low point before going for phase 4. So, like I said, the technicals are much more tainted to a less favorable structure in terms of Bitcoin, but I just think Bitcoin is the lagging liar. In that perspective, everyone think it's the weakest link in the equation right now. It's all about Ethereum's merge and so on, and it definitely has been the case. But I think anyhow and anyway, understand that the Bitcoin dominance is in an area in which it's not very smart to be extremely bearish in terms of a Bitcoin. I definitely think that the midterm is still going to be much more favorable to altcoins than it will be to Bitcoin, but it is also the area in which Bitcoin can at some point show some volatility. As we've seen, it's been a long time since we haven't liquidated the bears in Bitcoin, so kind of standing still in that perspective. I'm very cautious with Bitcoin, but I don't nearly think it's that big of a deal to the downside. In terms of stock markets, in here, if we go back to the 4-hour chart, still the same old story. It's a complicated market to navigate. The 4-hour charts has a lot of contradictory elements. The ones that we've said is that we were first lacking of volatility, and now we have an alert of volatility increasing severely. So it's really the market makers playing with time and people getting absolutely wasted in between. Totally correlated with the events that we've seen. In here, the market makers just flushed away the retail traders who were net short. They just kept on pushing and pushing until these guys reversed their position as the market retraced. And now we have the sign that the market maker is accelerating time instead. So this is kind of really playing around with space time, okay? So just don't be dumb enough. I definitely think that this is an area in which we could buy. We're in a supportive context, but this alert says pay attention to volatility boundaries as well, because prices might be demanded right there. Though if this is what this is all about, if we keep on playing time, there is a significant possibility for prices to surge into the into the volatility boundaries just to get to the mean back again. Okay, so understand that we will trade a lot more across the moving average when we have these, but the most interesting price areas will be around the technical volatility boundaries. So it is what it is. I think we have significant chances to go back to the mean in here while still having the clouds on top of her head, suggesting that there's a possibility at each and every time to get some huge acceleration in prices to get for those volatility boundaries. So what that means is that you can definitely trade those signals. I think we've got favorable contexts. 35 minutes from now, this one's going to be closed, detected by the algorithm, and there is definitely a bullish momentum in here, higher highs and higher lows, and we're trading at the support trade line. So this is definitely a bullish momentum. So if this one closes that way, I would definitely say that this is a tradable signal. The thing is that if you get to trade it, normally your stop loss will be the approximate size of the trend channel, and that would be positioning this stop loss right at the fucking Bollinger Band. So this makes no sense. This alert says we can go there. So what's the point of putting a stop loss where the prices could go? So that means if you're trading those signals, has to be divided by 2. You take a position sizing that is divided by 2, I would say a maximum 1% risk taking, which will allow you to double the stop loss and make you safe enough that if the volatility shows up, you're not going to be among the ones that will be stopped right at the bottom, okay? So this is what it is. Second option is you bet on the fact that the volatility will show up. Central banks will keep on shifting the playing ground and stuff like that, and in that perspective, you wait and you don't take these signals by betting on the fact that you will get better prices for a better risk reward in the future. That's the bet that I make because I already have a bullish exposition in my global portfolio, though the thing is that I don't have the reason to load up excessive amounts of risks when I have clear evidence that risks is still pending. So I'd rather like to take the opportunity if for whatever reason the market goes to the volatile boundary for whatever bullshit reason will be, I'll buy the dip, okay? But the thing is that I don't know if it's going to happen and I don't know when either. So I'm just patiently letting it happen. I think the likeliest outcome in terms of stock market is to retrace to the mean and get very boringly trading out there, waiting for either something to shock the market one way or the other. Remember that both volatility boundaries might be tested, and these signals generally tend to suggest that within their time span of action, which is 5 to 6 context boxes, so it is until early October, I think we have reasonable chances to hit both of them. So that's the reason why I'm cautiously waiting for potential better prices. But until then, if it goes up, I'm going to be very fine with that. That's the thing. Okay, some other narratives that needs to be debunked very quickly is the USD JPY. I had taken my stop losses earlier this week because it simply goes absolutely skyrocketing to the moon. Look at that. I mean, all the time frames are absolutely outrageously bullish. In here, this is actually excessive. Look at the context boxes totally being fucked up. We are doing exactly the same on the daily chart. So normally we don't have a look at dailies and so on, but look at that. Context will be unfolded on the daily, very excessive market. Weekly is excessive as well. So from what you can see, this thing has to be traded monthly now. So if you're taking trades on the 4-hour chart, which I was doing, you have to understand that you're not on the right time frame. So I think this is a monthly game now for USD JPY. Don't get me wrong, I'm gonna short sell that motherfucker just the way it deserves when the time comes. I just was wrong with the timing, so well, took my losses, take my pride off the table, and I'll do it again when the right time comes in the future. So until then, I'm stopping all short-term speculation. In the USD JPY, the market is going absolutely bonker with this, so I let it happen. Markets want to be stupid? Okay, go find your stupid boundaries, and when you'll find them, I'll be there to retrace. But until then, well, cautiously optimistic is the reason to be. I'm preserving capital rather than trying to be proven right or wrong. Okay, I just got wrong, probably wrong timing, and until proven wrong, I'm just going to let the market do its job. Congratulations to those who were bullish. Until then, I don't think the long-term trajectory for this market is bullish. I just think, well, if you can play it safe on the short term, don't forget to profit take and all of these things. But the midterm sounds pretty bearish to me, but I'm going to wait to get monthly signals before triggering trades in these markets again. There has been some technical signals to risk limit back then, but the market has in a couple of months decided to just flush them all away. So until further notice, keeping cool on USD JPY, waiting for better context to go back to this beast. Silver on the opposite direction is doing quite interesting things. I'm waiting for this one to tell me what its story is all about. I'd rather like to see it reversing the trend channel, because if it does, I'll be definitely willing to buy the next third range boundary. Will be the third in a row. Otherwise, if it fails and goes down, there is still a significant chance to deteriorate prices, because as you can see, this trend line is very low. I doubt the prices can go down there, but this is something that I still bear in mind. Right now, the current narrative is all about the dollar. Let's get it straightforward. Everyone is absolutely going bunker with the dollar. The dollar is going to break the world, put it to its knees. The emerging markets will default on their debts, and this will create a rippling cascading event. Once again, remember the psychology of those cascading liquidation events. They are unpredictable. And when we start the cascading events, the next step is always increasingly rarer in terms of probability than the previous one. So the more we advanced with those liquidation cascading events, the more the unlikelihood of the next one to occur is. Still, the more we advance in a pattern, the more the retails and general people tend to think the opposite way around. As the pattern has already played 5 or 6 times in a row, people tend to believe that the likelihood of the 7th is increased. But the reality is that it isn't. And this is exactly what we've talked about in yesterday's video. This is a clear dichotomy in between your natural risk perception And the reality, the math says the likelihood of the next liquidation to be even bigger than the previous ones and so on is getting very, very limited. But you guys perceive that it's inevitable. Everyone now thinks the crisis is there. We can't avoid it. The next liquidation will be the biggest ones in history, and the rippling effects of this will be tremendous cascading liquidations. Don't get it wrong. If it happens, and it can, it's just as crazily unlikely as winning the lottery. So think of it that way. Do you really want to play the lottery and predicting that this will happen to get a billionaire with this? Or do you really want to understand that there is a negative expect reward when you play the lottery? The more you play that game of trying to predict the crash, the more you lose money on a day-to-day basis. That's what the reality is all about. It took me a freaking long time to get there because I've made those mistakes before. But don't listen to these guys. They'll let you believe that this is inevitable, and because it happened 5 to 6 times in a row, then the 7th one is inevitable. Well, not the case. The reality is that the real math behind that says totally the opposite. It's not the appropriate time to start gambling on the next event to show up. It's the right time to say, if it happens, I'll take a stop loss. But if it doesn't, I'll be the ones who profit from the other one's mistakes. That's what I would like you guys to listen to, okay? So pay attention to this. Don't try to predict the future, but most importantly, don't try to profit from very unpredictable rare events. These are the dumb guys' business. There might be a little ones that succeed, Michael Burry's and so on. History is focusing on these guys, but also understand, if you ever had the chance to win the lottery someday, what are the odds to win it a second time? So you know that it's very, very unlikely. It's actually close to zero. Someone who won the lottery will very likely not win anymore. So don't listen to the past predicators. Those who succeeded in the past were extremely lucky back then. Or talented, yes. I don't think it's just luck. But the thing is that the probability for them to succeed again, very limited. So yeah, Michael Burry might have sold its entire portfolio. I'm not following it. That being said, wish you guys a pleasant day. Look at the technicals. Technicals comes with invalidation, and taking a stop loss won't kill you. It just means you tried something and it didn't work. So don't go anywhere beyond that, okay? Don't fear of being in the wrong end of the stick. If it happens, you're going to take a loss, which is not going to kill you. If you follow my strategy, every invalidated scenario comes with a maximum 2% loss. So is 2% capital loss the end of the world? I don't think so. So stay safe, trade safe, don't trade narratives. Bye guys.